Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, no one saw it coming. In a big positive surprise that took place in Switzerland, trade negotiators from the world's biggest economies announced on Monday a massive de-escalation and tariffs. In a carefully coordinated joint statement, the US slashed duties on Chinese products to 30% from 145% for a 90-day period, while Beijing dropped its levy on most goods to 10%. So while risk remains that tariffs go back up from current levels as the pauses end, it's gone some ways in reassuring investors that the worst case scenarios are taken off the table. In fact, some market strategists are saying that the future episodes of weakness should be used as buying opportunities. So, does this actually mark a buying spree for us? And drawing comparisons from past events, how are markets set to perform for the next half of this year? Let's find out with Vasu Menon, the Managing Director, Investment Strategy at OCBC Bank. Good morning, Vasu. How are you doing today?
Good morning, Dan, and I'm doing well. Thank you very much.
You sound happy, like most investors, Vasu, because like most investors, they're shocked into defensive measures at the height of April's chaos. It seemed like there's some swift recovery in the markets, and it has been considered as a mixed blessing. A gauge of US-listed Chinese stocks surged about 5.4% on Monday in its best session in over 2 months. The S&P 500 closed more than 3% higher. The dollar climbed the most since its November post-election rally. So that begs the question, Vasu, is the worst over for markets, and what does the US-China talk suggest about the possibility of a similar deal happening in other major nations?
Well, you're right, Dan. I think probably the worst as in what was defined after Trump announced the reciprocal tariffs on 2nd of April. We saw a big plunge in markets happening. That, I think, is largely over. But going forward, we could still see headwinds in terms of a slowdown in economic growth.
Yeah.
I think that is still ongoing. Inflation numbers could surprise on the upside slightly. But overall, I think the fears of a massive trade war, especially between the US and China, has now de-escalated quite significantly. Both powers have, caught, as you said, investors off guard. Stunned investors. First they were not even speaking to each other, and then they suddenly appear on the table, and within 2 days, they strike a deal, and that inspires confidence. And among the U.S. trading partners, China is probably the most significant, and this deal offers room for optimism.
Yeah, for sure. Definitely some feelings of optimism that we're seeing spread across the market. Now, let's talk a little bit more about, some of the comparisons that we can draw from the 2018 US-China trade war, which was considered, at least before 2025, one of the biggest trade conflicts in recent history. So, driven by unfair trade practices, national security concerns, and economic imbalances, it led to higher tariffs, supply chain disruptions, and market volatility. So, eventually it did brought some relief, to the deals that they had back in 2018. But the bigger trade issues, technology and global economic influence, continue to shape the US-China relations and international trade policies. So do you think we could draw some clues about, our current market outlook?
Well, if you cast your mind back to 2018, as you said, that's the first time Trump launched a trade war against China.
Yeah.
That trade war began in July 2018, the trade war between the U.S. and China, that is, and it is slowly built up. In the fourth quarter of 2018, as it built up and hit the climax, S&P 500 index fell by 20%, global equities fell by 17%, but there were also other contributing factors. The Federal Reserve was pushing up interest rates, and that displeased Trump, displeased the markets, and the U.S. government suffered a temporary shutdown. Now, all those factors caused the markets to plunge, but what's interesting is this. In December of 2018, Trump and Xi Jinping met over dinner at the G20 meeting in Argentina. That was a surprise. And just like now, it was a bit of a surprise. And what followed after that meeting and an easing of general concerns to the market was a huge rally in the S&P 500 index that went up by 44% over a 14-month period, and global equities as well, up by 33%. So the easing of trade tensions in December 2018 after the meeting between Trump and Xi Jinping helped in a big way. Of course, other factors played a part too, but if you look at history, it tells you that, what we're seeing is kind of a replay. Easing of trade tensions could provide significant tailwinds for markets.
Yeah, thanks a lot for that, Vasu. That's a good comparison that we've seen from 2018. So then it also, begs the question, are markets likely to start rallying from as they did back in end 2018? Because, we're seeing some optimism flooding into markets overnight. Can this continue? Is it overdone?
Yeah, so I think investors have to be careful.
Yeah.
Yes, we are positive on the outlook for the markets for the next 12 months. So when you say a rally, we are talking about, the current huge gains continuing over the next, 12 months, 18 months. We're not sure about that. We think there are reasons to be optimistic. We think that the markets have more upside. But at the same time, trade uncertainty has not completely disappeared because Trump has talked, for example, about imposing sectoral tariffs. He's imposed tariffs on steel, aluminum, auto, and he's talked about more coming up for semiconductors, pharma, copper, and lumber. So those have not happened. He said it's going to happen. It might happen. He's also said that, the 90-day negotiations with China fail. Then the tariffs with China will not stay at 30%, which he has slashed to. It could go up higher, not as high as 145%, but he has touted 80% before the negotiations started, right? And on top of that, he's imposed a 10% universal tariff. That's unchanged.
Yeah.
That alone is going to cause the U.S. economy to slow down. And at the back of investors' minds is, will it tip the economy into recession? Our guess is probably not, but nevertheless, the data in the coming weeks and months will be very closely scrutinized for the markets. And if you see any misses in the data, then, the markets could see greater volatility. So I think, investors should not let their guard down completely, but there are no reasons to be pessimistic or panic. That panic stage we've gone past it. I think now it's a question of how much upside there is for markets from here.
Wonderful. And of course, that also, brings the question, right? Where we should be looking at, because, you've rightly mentioned, some positivity that we're seeing and optimism flooding into markets. So where should we be looking at? What should investors be doing? If we want to put, let's say, maybe a defensive approach to our stocks?
Well, Dan, I think essentially investors should overweight equities. Where we are positive on would be Europe. We think there are tailwinds in Europe. We're seeing good news come out of Europe. And of course, if the Ukraine war comes to an end and surprises all of us, just like this trade deal, that's going to be a big plus for Europe. We are positive on Asia, Japan, China, Hong Kong. Clearly, this trade agreement is going to be positive for them. We're also positive on Singapore because the markets are cheap in terms of valuations. But we're not saying that, investors should throw all their money into equities. We still believe that it's important to manage risk through a diversified portfolio. And we think investors should also have bonds, but our bias is towards quality, as you said, defensive. And our focus is bonds with tenors of less than 7 years because they are less susceptible to rates volatility. And finally, for insurance, a bit of insurance in your portfolio, I think, gold makes sense. And we see a 12-month price target of $3,900 an ounce for gold. So we believe that, investors should take a measured approach to investing, keep a diversified portfolio, have a bit more equities if you've got the risk appetite. Make sure you also put in a bit of buffer through bonds because bonds are less volatile than equities, but with a focus on investment-grade bonds and, of course, gold to provide that insurance in case, something unexpected happens in the coming years. So put all that together, I think there are still opportunities to be had. And the developments in the last 12, 24 hours has given rise to greater reasons for investors to, look at markets more seriously now.
And there you have it. That's the blueprint you need to know for surviving the markets during this volatility. Thank you so much for joining us this morning, Vasu.
Thank you for having me on the show as well, Dan.
It's our pleasure. We've been speaking to Vasu Menon, the Managing Director, Investment Strategy at OCBC Bank. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.